So this last panel is going to focus on specific, the role of financial regulations. And we structured this where I asked each of them to focus on a particular regulation, explain what it is with no acronyms if possible, what it does, how it might have played a role in repo, and then each will just briefly describe that piece, and then we'll have a broader discussion about sort of all of them together. So, but I'm going to start with, so we have 4 panelists here who many of you know are experts. Sean Campbell is now with the Financial Services Forum, was previously at the board in both BSNR and the Research Division. We have Tim Clark, also previously at the Federal Reserve Board, BSNR, head of supervision. What was
Deputy
it?
director.
Deputy, so something in supervision. Jim Wygant.
Something. Who's counting? Who's counting, buddy?
Jim Wygant, previously head of complex financial institutions at FDIC, and Sandy O'Connor, who was just recently retired from J.P. Morgan as Chief Regulatory Officer. So we'll go each. There's a timer over here. Each of you have been asked to keep it somewhat brief so we can have a conversation. So we're going to start with Sean.
Okay, great.
Thank you.
So Nellie, thanks very much for the invite today, and thanks to the Hutchins Center. I think this is a really important topic, and happy to have the opportunity to engage in the conversation. So, while our focus today, quite appropriately so, the main focus today is thinking about the more recent repo market volatility that we saw in the past, few weeks or few months or whatever. I really think it's very hard to understand where we are in the repo market without understanding how we got here. And so if you think about the repo markets more generally, both in the U.S. and abroad, have been deteriorating for several years. And people in the repo markets and more broadly well understand that. So in 2017, the Committee on the Global Financial System, which is essentially a consortium of central banks, including the Federal Reserve, published a really good study on the functioning of repo markets that I would suggest everybody who's interested in this topic take a look at. And that report found pretty conclusively that repo markets have been deteriorating, that have been their robustness has been declining over time, and they cited a variety of evidence supporting that, including higher costs to end users and lower volumes and lower liquidity in the repo market. So if you think about a very basic analogy, in the repo market has been deteriorating. In some sense, the plane is flying a little bit closer to the ground than it used to be. So any bit of turbulence has the potential to do more damage, is going to be tougher to control. And so I think that, having that as a background is actually quite important. And if you think about that background, capital is actually quite relevant for thinking about that background. So in particular, there are 2 types of capital regulations, which I'm going to talk about today: leverage ratios and the GSIB surcharge. So a leverage ratio is a risk-blind capital requirement that measures equity relative to total assets without any, or in some cases, in the case of the supplementary leverage ratio, hardly any regard to risk. As a result, leverage ratios penalize an asset if it is low risk, like cash or U.S. Treasuries. A bank that intermediates repos between suppliers and demanders of cash will face heightened capital unrelated to its risk profile that just makes it less economic to intermediate low risk and low return assets like repo. The 2017 report presents data and analysis that specifically identified the leverage ratio as a cause of reduced repo activity. Moreover, a variety of academic researchers, including Darrell Duffy from Stanford University, have published a variety of research pieces showing that the leverage ratio is having a real and binding impact on the repo market. The second capital charge that I would talk about is the GSIB capital surcharge. So the GSIB capital surcharge is a capital surcharge that's only faced by GSIBs, basically the largest, most important banks across the globe, and in particular in the U.S. It's an extra capital buffer that applies to those GSIBs based on some notion of their systemic footprint, where their systemic footprint is essentially a quantity that is determined by regulation. It's effectively a regulatory assessment of systemic footprints. And in the context of measuring that systemic footprint, much of the problem that exists with the leverage ratio also exists inside the GSIB surcharge, in the sense that many of the factors that determine your GSIB sur score are effectively risk blind. So the simplest one to articulate is size. So overall balance sheet size is a factor that determines your GSIB surcharge, and size is risk blind. If you have $100 in treasuries or $100 in corporate bonds, your size is 100. So to the extent that size-related factors and other risk-blind factors are components that have a perceptible influence on the G-sub surcharge. That's also another source of basically a risk-blind capital requirement, which makes it less economically compelling to engage in low-risk, low-return activities that previous research and the CGFS report and sort of other sources have shown have led to a broad decline in the robustness of the repo market over the past several years. So that's sort of how we got to where we are today. If we think about where are we today and what's going on, there are also components of these capital charges or capital requirements that have sort of more acute effects that might be at play for understanding some of the short-term volatility that we've seen in the past and may see in the future. So in particular, turning back to the G-sub surcharge, and Governor Tarullo already sort of covered much of this in remarks, so I'll just sort of recap some of the points that he made. There are two parts of the G-sub surcharge which contribute to sort of this possible volatility in repo markets and potentially elsewhere. So the first is that the G-sub surcharge is set up in such a way, it's specified so that your capital charge jumps by 50 basis points every time your score jumps by 100 basis points. And to be clear, if you jump to the next bucket by 1 point, you have a 50 basis point higher capital surcharge. And for a large G-sub, that means $5 to $10 billion more in equity financing, which is significant. So the existence of a capital surcharge where you move in chunky buckets, economists call that a cliff effect, where there are cliff effects, basically creates a system in which you can have very big and abrupt changes to your capital surcharge. And if you're a bank, and if your G-sub surcharge is very close to that bucket or a little bit above it as we get close to the end of the year, you're going to have a very significant incentive to want to manage your capital, as you well should, and try and get below that G-sub capital surcharge level. The second point, which Governor Tarullo also mentioned in his remarks, is that a variety of the measures, not all of them, but a variety of the measures are based on the value of certain balance sheet variables on December 31st of the year in which the G-sub surcharge is going into effect. So this is another example of basically, of a design feature of the G-sub surcharge, which just means that you potentially have much more volatility in your G-sub surcharge because as you get close to the end of the year, whether your G-sub surcharge score is 100 or 101 is going to depend on whatever is going on 12/31 in that year. So those two things together sort of provide for cliff effects and incentives that lead a bank in many instances to want to manage its G-sub surcharge towards the end of the year. When a bank wants to manage its G-sub surcharge towards the end of the year, how is it going to do that? Most of the components that enter the G-sub surcharge are sticky and are relatively hard to move in a moment's notice. So if you think about corporate loans, consumer loans, mortgages, you can't basically increase and decrease those things very quickly. What can you increase and decrease relatively quickly? Repo, OTC derivatives. Things like that are easier to move on a dime, and so those are the things that in some sense bear the brunt when the G-sub surcharge comes into play. So I think capital, it may not be the thing that's at the top of the list, but capital, in particular the leverage ratio and the G-sub surcharge, should be on the list for discussion about the incentives that they create that may have had something to do in sort of the repo, the repo activity that we saw a couple months ago, the repo activity we may see as we get to the end of this year, and also the repo sort of kerfuffle that we saw at the end of last year, which happened and which was real, but just didn't create as much of a media splash as the one this September. So I guess the final, am I up?
You got 45 seconds.
Cool, all right. So in the last 45 seconds, I briefly want to cover what I think people should be doing about this. So in the 2017 report, the issuers of that report said that people ought to be really monitoring the repo market on an ongoing basis very closely, and I think that regulators and the public should take that to heart. And in particular, I think that a lot of the analysis that was conducted in that report could be usefully sort of extended to the modern period on an ongoing basis for further review and consideration by regulators like the Federal Reserve and the public, and that should be made public for all to see. If you think about what happened during the flash crash, which is not exactly analogous to what happened in the context of the repo market, but it was a sharp market event, happened at one point in time. Regulators in the government, they took a considerable deliberative period of time, they studied it, they wrote a report, they made those results public, and I think that did a lot to improve public transparency and understanding. I think much the same could be done here. The second thing is that regulators should be actively thinking about how bank regulations can impact other markets. I think we've heard that from a variety of other speakers here today, and I think that's really crucial, and I think that that's something that has not gotten enough attention in the context of the financial reform movement over the past 10 years, in that the way that you regulate banks definitely has the potential to impact the way other markets operate and other markets get intermediated, and that really matters and should be included when bank regulators are thinking about bank regulation. And then the final thing that I'll say is that I think it's really important to understand that details matter. Details really matter. God is in the details. And some of these things about, cliff effects in the GSIB surcharge, in the risk insensitivity in certain capital charges, and other people talk about liquidity rules. Those details and getting those details right is really crucial, and that regulators and the public really need to be attuned to thinking about those details.
Okay, great. Thank you, Sean. So we're going to turn to Tim Clark.
Okay, great. Thanks. I think it's really great to be here, and thanks to Brookings for hosting it. A very timely event that's, I think, gained much more interest than actually I would have assumed, as Nellie referred to in her opening comments. There have been a lot of different claims about the possible causes of what happened in September, specifically the repo rate spike, which is, I think, what we're here to talk about. It's great to talk about them all in one place, light them all up, and take a look at them. I would say, from my perspective, of all of the claims of the causes and the associated solutions that have been associated with these claims, the least compelling have been about banking regulation and supervision. There's really been no factual evidence provided of any direct impact from the regulations to what happened in September, unlike with many of the other things discussed today, including the shrinkage of the Fed's balance sheet, the growth in supply of treasuries, growth of the Treasury account, et cetera. Also, unlike some of those other factors, the regulations haven't changed recently, as Governor Trula mentioned earlier. They've been in place for a while, and regular periodic spikes in Treasury repo rates do happen. And it hasn't required the Fed to step into the market. And then lastly, the claims about the damages being caused by supervision and regulation have covered literally every key element of the post-crisis enhancements. So it starts to feel like some of this is just being seen as a really good opportunity to pressure the Fed into weakening important post-crisis rules. If there's real concerns about what's going on, and not just an attempt to use this to garner such changes, I kind of encourage everyone to take a little bit of a deep breath on the regulation and supervision side. We're not in a crisis, as has been amply discussed today. Thoughtful, fact-based deliberation is needed. It appears the Fed is doing that. I think that's great. I'm going to come back later to the Fed's comments yesterday about the comprehensive liquidity analysis and review.
I promise I'd ask. Okay.
So, while there remain questions about what's happened in the repo markets, what's not in question is that the stronger post-crisis regulations and supervision have made the largest banks more financially resilient, and that has made the system safer. My view, still not safe enough. There's much more work to do to reduce probability they could cause another grave crisis. But going in the opposite direction and hastily making changes that increase the probability of failure at these banks by weakening capital and liquidity rules isn't a good answer to any question, frankly. And I certainly don't think it's a good answer to how to address the repo market issues. I think a lot more thought needs to go into that relationship. So now I will actually turn to liquidity, which is what I was asked to talk about. The introduction of liquidity regulations was a huge and important development, and it has made the banks more resilient to a range of potential problems, including the type that directly contributed to the financial crisis. Pre-crisis, quantitative liquidity requirements were minimal at best, and banks' risk management and bank supervision in this area were, to be kind, not well developed. So let me briefly discuss the two most important ones that have come up, really the two things that exist. The liquidity coverage ratio, sometimes called the LCR, and the comprehensive liquidity assessment and analysis and review. So the LCR, the liquidity coverage ratio, as I mentioned before, so put simply, it requires each of the largest banks to hold a pool of high-quality liquid assets sufficient to cover stressed level of net outflows over a 30-day period. Seems pretty reasonable. Those outflows are expected to be higher the greater the use of less stable funding, such as short-term wholesale funding. So all things equal, the more stable the bank's funding sources, the smaller the pool of high-quality liquid assets it has to hold. Put slightly differently, the required size of the liquidity pool is appropriately a function both of the bank's size and how it chooses to manage and fund its operations. These are actually business decisions that banks make. For today's discussion, what's gotten the most attention is what counts as a high-quality liquid asset. Treasury securities and excess reserves at the Fed are treated equally and are both considered of the highest quality, as has been noted frequently. So the LCR does not constrain a bank from lending cash into the repo market to buy Treasury securities, full stop. Doing so has no negative impact on this measure of liquidity at all. But it's also important to think about banks' internal liquidity risk management practices, which is a good segue to the comprehensive liquidity analysis and review program that the Fed put in place after the crisis, often referred to as the Fed's liquidity stress test. Just to be really clear on that, CLR is not a Federal Reserve-run liquidity stress test. There are no specific quantitative threshold requirements that banks have to meet associated with CLR. CLR is an assessment of banks' internal liquidity risk management practices, including their use of liquidity stress testing and other liquidity metrics and risk management processes. It's an easy thing to pick on in a way because this is supervision, and supervision actually is not as transparent as sometimes I'd like it to be. I was going to stick to script and not run out of time here, so let me stop that. This type of supervisory program is critically important because, like any regulation, the liquidity coverage ratio cannot account for all situations at all banks, including that a bank might structure its position specifically to meet regulatory requirements while ending up with the same risk in a different form that's not captured by the regulation. This is one of the reasons supervision is so valuable. Simply meeting the LCR does not mean a bank can stop worrying about liquidity risk, and it's appropriate that the supervisors assess how good and how thoughtful the banks are at worrying about this. To look at how or if the bank's vulnerabilities that aren't captured by the LCR are finding their way into banks' internal considerations about actual liquidity needs under stress. Okay, I am actually going to just move this one aside, I guess. If you're going to ask the question, I will. So one last point in closing, their capital and liquidity regulations can and do affect banks' business decisions, and they may constrain their activities if you define constraint as attaching a higher cost to a bank, the greater its level of risk and the risk it represents to the system. They don't actually restrict the engagement in those activities. What they mean is they need to have appropriate levels of capital and liquidity to support them. The post-crisis regulations increase the level of confidence we can have in the largest banks that they can withstand another severe downturn, not turn into a full-blown crisis. That's a critical goal. In my view, that level of confidence actually should be and could be higher still. And I think capital standards could be and should be higher still. And importantly, addressing the too big to fail problem via resolution planning and trying to set up a system where you can resolve a massive bank in a time of stress without disruption is far from complete. In the meantime, we're left with the critical importance of the other key pillar of addressing this problem, which is reducing the probability of default at these banks in the first place. Those are strong capital and liquidity requirements. That's how you do that. If for some reason it's determined that liquidity standards should be loosened because of these events, which I really think would be a mistake, and maybe there's more information that will come out, and like I said, it should give them thoughtful consideration. I think there will be a need for significant offsetting increases in capital requirements to leave the system as just simply unchanged from its current level of safety, which, as I already mentioned, I think should be higher. So I'll stop there.
Thank you. Thank you. Jim?
Okay, there's nothing worse than starting a discussion about resolution planning and already seeing some members of the audience yawn. I mean, this is actually going to be a hopefully good tie-in to some of the comments made earlier with respect to how resolution planning, which some of you may be asking, can relate to the repo market. Large financial companies are required to develop plans for early resolution under the U.S. Bankruptcy Code. Now, unlike the FDIC's authorities for resolving banks or insured depository institutions under the FDI Act, or systemically important financial companies under Title II, where the FDIC can either use working capital from the Deposit Insurance Fund for resolving banks, or have a borrowing line with the Treasury to resolve a systemically important financial institution under Title II, the companies that have to put together Title I resolution plans under the Bankruptcy Code have to rely on private sector sources to fund their bankruptcy. Now, what was the largest source of private sector funds ever to be used in a bankruptcy? $10 billion. That's it. So that's the largest source of external funds to fund a bankruptcy, $10 billion. So the regulator said, look, institutions, in order to develop plans that we're going to view as being realistic and feasible to execute, you're going to need to rely on internal funds to be used as working capital to basically fund your bankruptcy. What this meant is that the entities had to do two things. They had to model the quantum or the amount of working capital or liquidity they're going to need in order to work through their bankruptcy. And I'm using the term working capital there both in the context of ensuring that the amount of liquidity is sufficient to keep, in order to execute the plan appropriately and keep the operations that need to be operating doing so, okay? And because there are certain operations that are performed by these companies that you don't want to cease. So it's both the liquidity necessary to do that, and then also the actual capital amount that is necessary in order to ensure that they satisfy regulatory requirements and that market confidence is maintained, that those entities have the ability to do it, okay? So to some extent, we're talking about both capital and liquidity here. And in both cases, both have to be modeled. And in that modeling, the institution's plan itself drives the quantum that is necessary in order to be identified as the successful amount for plan execution. So, in that modeling, depending on what the plan contemplates, the entities themselves will develop a set of assumptions. The regulators don't impose assumptions on the entities because each plan is idiosyncratic based on the footprint, the business model, the characteristics of the entity itself. And so, a blanket set of assumptions really isn't realistic. So they're dependent on the entities to develop the assumptions themselves for this type of modeling. Now, one of the expectations, though, is that if you're monetizing assets, you're going to have to look at a realistic market reaction to what you're going to recover in converting that asset from something other than cash into cash. And so the rate at which you're monetizing an asset and the market step and ability to monetize that asset at a certain price is something the regulators are going to be looking at. This is something which we've heard is an incentive for cash versus treasuries, because if a high volume of treasuries are being monetized at one point in time, then there's going to be a discount imposed by the market because you're putting all these treasuries, monetizing them in the market, so there's going to be a discount provided on it, and that discount is something which indicates a preference for cash. Now, there's no stated preference in any of the guidance that is provided by either the Fed or the FDIC on resolution plan. There's no stated preference for using reserves in the resolution process. However, it is a market reality, and I think a very realistic assumption, that if an asset class is being monetized in the market, that a realistic view as to what the market is willing to pay for that asset has to be taken into consideration. And that's what basically the regulators do when they review the resolution plans. So, how does all of this end up relating to business as usual? Because when we're talking about resolution, none of these institutions today are in resolution that may participate in the repo market. And resolution, at least for now, is a hypothetical exercise. So how does this relate to basically their ability to participate in the repo market today? Well, the amount of liquidity that gets calculated, it's positioned within the entity, and it's positioned based on what the needs are in for resolution planning purposes, where the needs are in order to successfully execute the plan. The quantum is also, that pool of liquidity, that quantum, that amount, is also combined with satisfying the other regulatory requirements Tim alluded to with respect to prudential supervision, safety and soundness. So you're looking at the entities using this pool of liquidity basically to say, all right, this is the amount we're going to have in order to operate safely and soundly and to satisfy our prudential regulatory requirements, and it's the amount also, or a subset of it, that we're going to need in order to execute a resolution plan. So it basically serves those purposes. Now the question becomes, is this amount of liquidity, and the liquidity has to be the high quality liquid assets, and once again I said there's no stated preference with respect to treasuries, which is a high quality liquid asset, or reserves. Is that amount of binding constraint? So I think that's the first question regulators can take a look at. Does this amount of liquidity necessary to successfully execute a resolution plan hit the threshold of being a binding constraint, or safety and soundness or other risk management liquidity requirements actually the binding constraints. Next question I would ask the regulators to take a look at is whether or not the expectations associated with resolution can be better communicated to the banks and to the systemically important financial companies with respect to some of the issues that have been raised today. So Governor Torello mentioned earlier daylight overdrafts, and that has basically created in resolution planning an issue with the willingness of institutions to go below a certain amount of reserves. Well, maybe, maybe not. I don't know the answer to that. But that's something that certainly can be looked at. And my recommendation would be for the regulators to both see whether or not there is a binding constraint that occurs with respect to the liquidity required in order to successfully execute a resolution plan, and then also whether or not other aspects of developing the models that are used to calculate the amount and the positioning of that, whether or not there are other aspects of that which in fact need to be reviewed in the context of how an institution operates in the business as usual environment.
Okay, I guess I'm on cleanup before we get to
Yes,
questions. What I'm going to try to talk a little bit about is the impact of some of these regulations in aggregate, because you heard each of them described sort of individually, and some other interactions. And I'm going to take on first, though, just a couple of comments around regulations haven't changed much in the last couple of years, because a few of the different panels were talking about that. So therefore, how can it be an issue now? And the reality is, yes, we've been in implementation mode collectively in financial services. However, what has changed is the amount of excess reserves that Bill has been talking about is down dramatically. So when there was an awful lot going around, the impacts of optimization could be less obvious. So I think that's just important. So the fact that you haven't seen this before doesn't necessarily mean that it's not at all related to, although I would agree, no one should be running around and saying it's only about regulation. There's an awful lot going on here to point to any single variable and call that the major cause. The second thing that I would say with regard to sort of liquidity and liquidity management, I think it's very, very important to note that it's essential to keep the operating model functioning. But just like capital and financial stability, more is not always equal to better. You have to understand the aspects of liquidity and collateral and their importance in lubricating the system of financial services to make sure that cash moves from those that have it to those that need it. Trish talked a little bit about that as it related to, financing against collateral. Those are important aspects, and the key here is now finding the balance. Now, that said, I don't think it's about rolling back anything. And what do I think there's opportunity for? Well, we have a whole bunch of rules that target a lot of the same risks, many of them very highly and appropriately focused around short-term wholesale financing funding. Now, short-term wholesale financing, if I could speak. And here the issue is, do each of those rules, as they layer on top of each other, make the system safer and sounder, or do they just change the cost? And I think that's an opportunity to take a look. Because if they're making the system safer and sounder, that's fine. Where they're just layered and don't contemplate the other rules that came before it that already address the risk, if it's dressed appropriately, well then, clearly, it's going to be a less attractive, less economic trade for the traditional intermediaries to go after. So on to sort of the remarks I prepared. Dislocations between cash and collateral on a temporary basis happen all the time. They have happened all the time. Again, you have different sectors operating with different criteria, and that's the norm. What is different is in today's environment, how the intermediaries function has changed. And of course it's changed. We've put in place a variety of different regulations to change the actual behavior, the amount of liquidity transformation that they did, the footprint, the size. So that can't be a surprise. But the real question is what we want to be intermediated actually being intermediated. So a couple of things that to think about is, while requirements broadly changed, They've resulted in changing behaviors. They've also resulted in changes in how people interact in the short-term wholesale funding market and the economics of certain trades. And by the way, the economics of certain trades, most importantly, in that short-term wholesale funding space. So what does it look like these days? Banks have a lot more HQLA. That's a good thing, right? Because we should be able to collectively ensure in our financial system that liquidity stress can be met. As mentioned by some previous panels in here as well, the SLR and GSIB surcharges have been put in place, but they're size-based, not necessarily risk-based. So they can weigh more heavily, again, on this low-risk, low-margin U.S. Treasury financing. And why do we care? This is not about financial services institutions. We care because risk-based metrics around financing the Treasury market matter. They really do matter because we want to make sure that we maintain the health and soundness of the functioning of the financial markets. And by the way, that impacts the cost of debt financing for the economy, which means taxpayer value, right? And it also means that so many other corporate borrowings that are tied to the underlying cost of Treasury are impacted in price as well. So this is not about, again, banks per se, and I think that conversation has to be broader. It's really about the cost of financing for the government, the economy, as well as banking institutions. I think while binding constraints, people have mentioned them here, the reality is the framework, and I think Governor Tarullo would agree with this, the framework was written to make the bonding constraint move, right, through time and can be different based on a business model. Well, as a result, you actually have financial services institutions that are managing their capital and liquidity in a much more centralized way and with a lot less flexibility, with a lot more cushions, because the cost of getting it wrong is quite expensive. And moving to now a couple of other thoughts. While folks say, well, financial institutions have so much HQLA, and whether it's cash or it's Treasury and so much in excess reserves, why didn't they show up in September? Right? Why didn't they show up? Well, just because their excess reserves were greater than the reserve requirement, it didn't mean that the cash on hand or the treasuries weren't earmarked for something else. And that goes back to some of the other comments that were made here. So firstly, Bill Nelson talked earlier about the volatility of settlements and the intraday overdrafts, right? This is really an important feature here. The largest banking institutions manage so many settlements, both in deposits and in securities. The quantum is enormous. It varies both in the size every single day as well as in the timing with which it occurs. So as a result, excess reserves are really the shock absorbers, right, to ensure that you don't breach intraday overdraft. Well, maybe there's not so much excess there, if you will, from a management perspective, because there's a stigma that is associated with that potential breach. There's also a low tolerance, as we talked about earlier, for any of those intraday overdrafts to occur. So there's a risk aversion. As excess reserves come down, guess what? There's a lot less willingness to lend out that last dollar because it could result in an overdraft. And it's certainly, you wouldn't want it to result into an overnight loan that may not come back the next day in time to meet your next series of cash flow. So besides that, the day-to-day management, you have this bank management liquidity stress testing, which is occurring monthly, right? Management teams can be more conservative than what the LCR is doing. So in fact, they're going to look at cash and securities, and they might, again, earmark a piece that they want to keep on their balance sheets. Talked about the non-public supervisory assessments as they relate to the comprehensive liquidity assessment, and then, of course, what we talked about related to resolution and recovery. Now, the resolution recovery one, I think, is very important because there is this distinction between our reserves preferred over treasuries. And the reality is we are financing today, earmarking today, liquidity and collateral for the potential eventuality of a substantial demise. And the real question is, maybe there should be more fungibility between treasuries and reserves in that instance, because this is the nearly risk-free asset in the world that we're thinking about. And the other piece here, which we haven't spent a lot of time talking about, is the changing not only market dynamics, but also the market players. Everyone's mentioned asset managers, right? Asset managers have become substantially bigger participants in both auctions as well as in the repo market. You talked a little bit about the decline in repo. Over this course of the last year, a former colleague of mine, Alex, mentioned, repo's up 30%. The repo market, repo financing is up 30%. No surprise. Why? Because the deficit's up, right? Well, who's doing all this repo? Well, you have the primary dealers that are underwriting all of these auctions, so it's sitting on their balance sheet. Well, who's financing them? Asset managers are financing them. Asset managers are providing $1.3 trillion, again, another number thanks to a former colleague of mine, Alex, $1.3 trillion in repo financing against U.S. Treasuries. That's up $300 billion year on year. And so when you saw that tax day change, well, there's a withdrawal, and a withdrawal from the money funds, as well as then a pullback from repo financing, because the bulk of that financing is done on an overnight basis. Why? Because money market funds also have new liquidity requirements, and they need to have highly liquid assets, hence they're buyers of bills, and hence they're big users of repo. So now you're faced with, well, you have a pullback by a sector driven by those types of criteria, nothing wrong with it. And by the way, think about the investment thesis. The investment thesis of Govy funds is very similar, and the investor behavior of those that are putting money into them is equally very similar. So you've got a footprint that's more highly concentrated and operates in a very similar way. And there you come back to then, so now what? Who's going to provide that financing when those dislocations occur? Because the traditional intermediary may not, because of the increased cost of capital on these low risk, low margin activities, they're not likely to be the marginal buyer of repo or provider of financing in that environment. And I will stop there.
So thank you very much for very well-informed discussions. I'm going to start with one question for everybody. So you were all asked to focus on something specific, but let's assume the Fed increases its balance sheet a bit with the term and the repo that it's done. So there's a bit more reserves in the system. We're not operating, on the steep part of the demand curve. If there were one change in regulations you would make that you think would help the repo market, and sort of be narrow, what would it be and what would its costs be in terms of financial stability or safety and soundness? So it looks like Tim is suggesting you start.
I'm suggesting anyone other than me start. Yeah.
Nice.
So, it being so close to Christmas, I can't possibly pass up the opportunity to.
What's an old friend for?
So, I think that's a really important question. And again, if I think about Christmas just a little bit, for just a second more, rather than sort of provide an answer around, well, I'd really like a pony or I'd really like a new iPod or something, I really think it's important to think a change that I think would be very sensible and very useful for improving the repo market and potentially other markets too, but definitely the repo market, again, is for this point that I made at the end of my remarks, which is really for it to be the case that bank regulators think very seriously and very carefully about the impact of bank regulations on other markets, including the repo markets and the cash markets that repo markets are financing. And a point that was that I think I heard in Governor Tarullo's remarks this afternoon, and I'm sure he'll let me know if I misconstrued it, is that at some point, if we try to make the banks safer and safer and safer, especially with respect to a liquidity situation, we are going to make the rest of the system less safe. And I think that what you saw in the repo markets this September was a situation in which there was clearly a less permeable barrier between the banking system and the rest of the financial markets. And that is not necessarily isolated to the repo market. There are lots of markets that banks intermediate where that lack of permeability could be a problem. And I think that I think we should all agree from a sort of first principles perspective, what we should care about is maximizing financial stability in the U.S., and that is not always the same as maximizing financial stability, especially from a liquidity perspective, of the banks.
Mm-hmm. Thanks. Anybody else?
I would say that, there was a comment made earlier, I think Sean made, I'll say the devil's in the details instead of God's in the details. And, a lot of this modeling is based, some of the modeling, not a lot, some of the modeling is based off of point in time versus several points in time or rolling averages. And to the extent that there are models that deal with liquidity and capital, then perhaps taking a look at changing those to being averages or over multiple periods of time instead of points in time might be a worthwhile exercise, because it then avoids kind of the window dressing effect, the blip that you get where institutions start managing their balance sheets in order to satisfy a regulatory requirement. And to the extent that something can be done with respect to that, I think it'd be a worthwhile exercise to investigate it.
So I guess I'll, honestly, as I said before, I'm not sure that all the time has been taken to thoughtfully consider all of this. I can't really think offhand of a liquidity or capital regulation that I would trade, given what we just learned about the repo markets in the last couple of months. But I guess this is strangely, I may be agreeing with some of the comments made by some of the folks who've been weighing in on the sort of what's called the industry side of this one about the GSIB surcharge calculation, but I don't think we have the same solution. If we're worried that that calculation actually is leading firms to take significant market-moving actions to do window dressing at the end of a period, I would actually measure the GSIB surcharge at its peak point throughout the period, so that a firm actually is, when it's measured, when it's at the point where it's the most systemically important, that is the capital that is required to hold.
So just to,
I
hop
don't
in.
think that's what they meant when they said it, but yeah, I think it's a good
I have to
idea.
That would be
say-
really good for market continuity.
I have to say, I'm so glad I retired. But one thing I will say is, several of you awesome guys up here have been talking also about window dressing, and there definitely is, institutions manage downward. But I think it's important to note, again, my past experience is that you cannot engage in intermediating and use it as a spigot in a massive way, period, full stop. So, by the way, I'm not averse to going to sort of an averaging or reducing a step function, but I think it should be clear that it's not like folks are ramping up enormously and then slamming it down, because that's not acceptable to your underlying clients, and that's who you're providing intermediation for. You can't disappear. And so for me, I think the couple things that I like the idea about treasuries potentially being considered as reserves, because that could free up potentially for intraday activity moving back and forth, and it doesn't add risk to the Fed or to the environment. That's sort of an interesting. I'm looking at Bill because he's the guy that put that one up there. I think that's a pretty interesting one. But I also think. Not getting rid of any one rule per se, but really looking at them now as a package, because they are a package. When GSIB surcharge, both the calculus as well as the rule itself were written, it was sort of assuming nothing else was in place, because nothing else was in place. But there is an awful lot of bits in place, and while we can all agree that resolution and recovery has come a long way and may not be fully done for everybody, the reality is if you've got lots of resolution and recovery in place, then the risk of systemic footprint that is meant to be mitigated by the GSIB surcharge, there's probably some offset that could occur there. So I would say look at it as a package and see where there's opportunity to unpack and sort of get the risk assessment right and the cost right, because if you get the cost right, more people will transact.
Okay, great. So let me, I want to follow up on, and I'll come back to your question, Tim. So I want to follow up on one thing, which is sort of market dynamism in the money markets and that sort of effect there. And Sandy, you mentioned the growth of money market funds and govie funds and big buyers of treasuries or reverse repo. And so is it your view that sort of concentration in this market, in the repo market, has changed, or it's more money funds and less dealers, or that is changing it, and is any of it due to some of it, of course, is money fund reform, but is any of it due to bank regulation?
Yeah, look, I think sort of all of the
others.
above. Firstly, anytime you add more diversity into the market, it's a good thing. I think my point is really the market's different, the players are different, and who's engaging day to day and what their behaviors are is fundamentally changed. Therefore, how we manage the flow of collateral and cash have to adjust accordingly. So when you think about the rule changes in asset management, that the two big ones were the floating net asset value for prime funds. And what did we see? We saw over $1 trillion move out of prime and into govy funds, right? And then, of course, the liquidity rules associated with both prime and govy funds that make sure that you have enough money on hand to meet the expectations and demands of those investors. Those bits, they make really perfect sense. But that means you can have starts and stops on the financing. Doesn't mean it should go away, but it's a different characteristic. And you've got this push. Those liquidity rules actually push asset managers in money market funds to overnight repo. They're not going to term out. So the answer isn't go term out. They're not going to do it in a substantive way because they need access to that liquidity, which is exactly the opposite of what you'd want the broker dealers to be doing, which is take down term repo. So you've got a mismatch in the drivers for liquidity on both the buy side and the sell side. So how do you think about that? And particularly when it comes to sort of the U.S. Treasury market. So again, I don't think it's bad or wrong. It's just a matter of, so what do we do on those tax days, and how do we ensure that intermediation can occur appropriately or to the best of its ability, and where intermediation can no longer provide the elasticity of balance sheet, well, who can provide it for U.S. Treasuries? And that's where I think we've already seen the Fed stepping in. And the one other comment that I would make is with regard to, buying bills, that's a really good idea, right? However, I would also say one of the largest buyers of bills these days are the govy funds themselves. So the question is, since they're buying them because they've had $500 billion worth of flows come into funds this year, are they really going to be willing to sell those bills in the size, the quantum that the Fed wants? Or do you have to start thinking also about coupons? So again, the behavioral, the drivers, they all need to be contemplated, and it's much more, it's not so binary, I guess.
So Nelly, if I could make one point. So I would say, the first thing I would say is that trying to understand whether or not the repo market is very concentrated is difficult in my opinion, because there's a tri-party market, there's a bilateral market, the data's not where it needs to be. To the extent that that's occurring, things that I've been sort of hearing about and reading about, so and one thing that was already mentioned this afternoon is the increase in centrally cleared repo. Yeah. So that has the potential to give some rise to a little bit more concentration, because the way that those utilities are set up is that they have a relatively small set of members, at least now, that's growing over time, so that will improve, but right now it's a relatively small set of members. So then you ask yourself, well, why is that? Why are people going to centrally cleared repo? People are going to centrally cleared repo because the bank gets the netting benefit and they get to cut it out of the SLR measure. Mm-hmm. It's a capital-related incentive. So this is exactly the point that I was trying to make earlier. We need to be asking the question, what is it in the capital regulations or the liquidity regulations or whatever else that's leading to these kinds of activities in other markets and closely related markets? And I think the centrally cleared repo example is a good example of where that's occurring.
Any other responses? Okay, so I'm going to turn to the issue of rules versus supervision, because this has been a big issue lately. And so I'll start with Tim, and maybe Jim might want to say something, and others can join in. So in Q&A yesterday to some testimony that the Vice Chair Quarles gave at the House, I believe it was the House, he mentioned the Fed may have created some incentives that contributed to the spike in repo rates. And particularly among them are the internal liquidity stress tests that we run, quote unquote. So, but Tim, you just told us the Fed doesn't run the stress tests, the banks do. So could you just explain a little bit what?
Sure, yeah, happily. Let me start by expressing my gratitude that he used so many qualifiers in the statement, because it's clearly still very uncertain what the relationships are here. But so the Fed, as I mentioned before, comprehensive liquidity analysis and review does not include a Federal Reserve stress test, and there are no binding minimum thresholds as any part of it. For the stress test part of this is the Federal Reserve assessing the firm's use of internal stress testing for liquidity management purposes. Jim actually said this quite nicely, but I'll reiterate it, and hopefully as well. I think what they mean, and I don't know this for sure, is that the preference for cash over securities that shows up in these internal stress tests is because, unlike in the LCR calculation, which appropriately, as I said before, treats treasuries and cash the same, a bank's liquidity stress test may not, and frankly, probably shouldn't, I don't know if this is well, actually not probably, it shouldn't. I don't know if this is exactly what they meant, but I'm assuming it. So put that another way, banks, liquidity risk managers, and supervisors have learned a couple things from experience, thankfully, that turning treasuries into cash is different than having cash. First, you have to turn the treasury into cash. You have to either sell them or you have to use them as collateral in repo. Sometimes, particularly in a stressful environment, which is what stress tests are testing, and as a function of the size of the amount you need to sell, when you try to do that, you're not going to get as much as you would like. And you're not, cash is cash. Treasuries are one step removed. They're extremely, they are the second most. But so it's actually, I think reasonable for a large bank to be thinking about in the stressful environment in which it might have to unload a huge amount of treasuries to fund it, so to get cash, either, again, through selling it, through repos, using it as collateral, et cetera, that the haircut they could take could be quite large. That's a very rational concern of the banks, borne out by history, a rational concern, I think, for supervisors to be thinking about. In fact, I go a little bit further. If risk managers and management of the banks aren't doing that, then I think it would be kind of frightening. And if they're not making it clear to their boards of directors that a bank might have to spend a few extra dollars to build a liquidity pool because in the event of stress, their treasuries might not be worth 100 cents on the dollar when they sell hundreds of billions of them at the same time, then I think they wouldn't be doing their job very well. So that's my view.
I mean, the only comment I'd add to that is much of this is nuanced, okay? And a discussion of preference versus incentives versus requirements versus regulations, whatever. I mean, the reality is that I think the communication between the regulated entities and their supervisors is extraordinarily important, and that communication needs to be clear, and I think a lot of it actually could be more transparent. I think Tim mentioned this earlier, that it would be nice to have a little greater transparency in the supervisory world. Once you get on the outside, you appreciate it more than when you're on the inside. I can say that from experience. But the reality is that the communication is extraordinarily important, and if, for example, an aspect of resolution planning is being unintentionally carried over into business as usual, then there should be a discussion around that, and there shouldn't be a reluctance to talk about it. And there might be very rational reasons why it makes sense. I mean, as Tim indicated, I mean, I think, it's a very reasonable assumption that if you're selling a lot of an asset class into a market, there's going to be a haircut that is taken at that point in time, regardless of what the asset class is. And so having a discussion around this, it just serves in anybody's interest, and hopefully will make the system better.
Just again, I think back to, the LCR, the CLR, and the resolution recovery. That's a continuum of stress tests, right? And while I agree completely with the LCR and agree completely with the CLR, because you are liquidating under stress, and if you're liquidating a treasury bill, it's going to have or note, it's going to have different aspects given size versus depth. The question that I would posit, though, is for resolution and recovery, right? Resolution and recovery, are we making the right trade-off between holding massive amounts of cash up front because it's preferable to treasuries for what is a low probability outcome? And one can argue, so what? Let's have it that way. But then we can't be surprised of the consequences of lots of cash and liquidity sitting on financial institutions' balance sheets that are not available for the traditional daily operating of movement of cash and securities through the system. That's the only one I'm thinking of.
Can I just before I pass it to you, so I just want to be clear, because part of the point of here is to be, so CLR and resolution and recovery are not the same thing.
They're different. They're very different.
So what I was talking about was CLR and risk management, and fortunately, Jim can talk about resolution and recovery.
And with respect to, for example, an incentive to hold cash versus an explicit preference to hold cash, it goes back to the question is, what's behind the incentive? And if, in fact, the incentive is to avoid daylight overdrafts at the bank, because this liquidity is just more than at the bank level. The liquidity in resolution planning is for the entire enterprise, and much of the liquidity demands is actually driven the acute liquidity demands is driven by the broker-dealer affiliate. So when you're looking at the resolution plan quantum liquidity requirements, and what that is composed of, you really need to break down what is your objective associated with that. And if in fact, for example, build confidence, avoid intraday or daylight overdrafts, that's an issue. And if the requirement is, well, you need this level of cash to do that, then you have to have a discussion about the balance and the trade-offs associated with it.
So we can turn to, if anyone has a question, if you raise your hand, there are some microphones. Either that or I'm going to ask a couple more as we're getting ready.
Worn them
Okay.
down.
So I'm going to just raise one. I'm going to put Sean on the spot for a second. Because
like old
this is,
times, Melanie.
yeah, I know. But he always, so the GSIB sort of suggests that there are some capital and balance sheet constraints over year end. That it's not clear the Fed putting reserves in the system solves that problem, but I'm not sure.
Okay.
So how concerned are you about year end?
So again, I think it's, I'd like to address the sort of the first point you made, which is this issue about putting reserves in the system. I think there are real questions about whether or not that is going to work if the primary intermediaries that intermediate those reserves feel as though they're full up for the end of the year.
Yep.
Seems like
That's
a really, you don't need a PhD in anything to get that one, in my opinion. The second point is, am I worried? So in some cosmic sense, if I look back at last year, there was definitely something that went on in repo markets last year. It didn't get the same press that the September event I got, and not much has changed in the interim. And so we're heading into another year end.
It wasn't a crisis.
That's true too. So we're heading into another year end. So do I think that there's sort of a possibility, or is there scope for there to sort of be end of the year volatility that is driven by that regulation? Yes, I think there is. Do I think it's going to result in a financial crisis, or it's going to be something that the world can't handle? No, I don't think that, broadly speaking. But actually, this gets to a broader point, which was raised several times during the presentations today, so I want to address it now, which is there's been this point made a number of times, which is like, well, volatility is good, and a little volatility is a good thing, so what's the worry? So the worry is if the volatility is self-inflicted because of a design flaw in regulation, we should all agree that that's a mistake. And we should all agree to take a hard look at that and fix it if possible. So I would be, as an economist, I would be the first thing to say that volatility is healthy in the economy, and that sources of volatility beget trade and exchange of views, and that's good in a healthy economy and also in a democratic society. But if the volatility is being driven effectively by a design flaw in the underlying regulation, there is no good argument for not addressing it.
So I think, yes,
From the ground?
okay, yeah, we should let, yes. Dennis, yes. If you stand up, I have all kinds of questions I could ask, so I just want to let the
I saw one
audience.
person in the ground raise their hand, so I thought we'd give it a shot.
Well, I don't know if I want to go before Bill. I think I want to go after Bill. But Dennis Kelleher from Better Markets. One thing it's interesting, and Sean just alluded to this, but a theme through all three panels is that September, nobody thinks that's going to lead to a major crisis and a failure, kind of a cascading failure, so other than Sean's question earlier about maybe it's a leading indicator, but maybe it is. But let's leave that small probability aside and say there's broad agreement that doesn't mean we're going to have 08 all over again. And Sean just said, as for end of the year, could we have increased volatility? Yes. Are we going to have a massive collapse of the financial system? No. Everybody's saying it. And that's the forest that occasionally gets mentioned. And the rest of the time, we're talking about the trees, and the particular tree, which is the repo market. But I think one of the reasons there's broad agreement that none of this is going to lead to a collapse or a cascading crisis is because at the macro level, we have massive resiliency now. Now, maybe it's not where it should be. Maybe there should be more capital. And yes, it's better than 08, but is it where it should be? I don't know. But it's certainly miles and miles away from where we were in 08 in terms of resiliency. And that's because of numerous rules, regulations, changes in practice, changes in markets. And so you're saying if there's a design flaw in this particular market, and then Sandra and you both talk about there being many markets, we're only talking about one, there's a little change here and let's a little change here. And each change you're talking about relates to capital and liquidity. That's what makes it so stable at the macro level, though. That's why everybody here can so comfortably say it didn't lead to a crisis in September, and it probably won't lead to a crisis in December. The macro level, the resiliency and stability there is what gives you that comfort. And so when you talk about the changes at the micro level, are you worried about each one cumulatively leading to a question for your overall your premise of all these discussions of the resiliency at the macro level?
So I don't think you've appropriately characterized why I'm not worried. So it has nothing to do with the fact that we have so much resiliency in the banking sector that we don't have to worry about anything. It has everything to do with the fact that we're in basically a 3.8% unemployment macroeconomy. It's the strongest macroeconomy we've seen in a generation, maybe in 50 or 60 years. And right now we are at the top of a very robust macroeconomic business cycle. As was already raised earlier by other people today, we can't be sure how this will affect the economy and the markets if we were in a much more precarious economic situation. No one has repealed the business cycle. We're in a really good spot today. I would grant you that part of that is probably due to the significant improvements in capital liquidity that has happened from the crisis, but that is absolutely not the sole reason, and that does not portend that these problems, if they raise their heads in the future, couldn't be a problem. And I think this also, this is an important point because we're having a conference today about sort of the repo market problems that occurred in September. Who wants to put an X on the calendar for the future Brookings Institution sort of seminar on the volatility that occurred in, say, the corporate bond market? And some of the fundamental concerns with these regulations that are being discussed today have the potential to cause volatility in those markets, just in the way they did in the repo market, and that may not occur at a point in time when the unemployment rate is only 3.8 or 4%.
Can we just take a couple more questions and then?
Yeah, I just slight response though, but
No.
there's a I'm not even sure how to respond to what Sean just said, but there is an extent to which regulation has made the system safer and more resilient. That's a good thing. Have those regulations created some incremental volatility in markets that have been incredibly unvolatile? I'm really not even sure what your point is, to be honest, on that one. But so I guess, are you arguing that we need to roll back regulations that make the banks safer in order to?
No, I'm saying if you find a design flaw in a regulation that is adding volatility that does not have any policy goal attached to it, then that's a source of inefficiency that you should squeeze out of the system. That would be the same, if, Tim. That would be the same if you were building a car or a house. It has nothing to do with regulation. Or it's basic efficiency in trying to govern a system. If there's something that's wrong, that doesn't have any policy benefit associated with it, let's not have it. If we can't agree on that, I think we don't have much to talk about.
Yeah.
Okay, so Bill, question from Bill Nelson.
Melly, I got to say something too. Sorry.
We haven't found anything wrong.
No, but I think, you talk about volatility is fine. You have to look at what the driver of volatility is. And we've already discussed, right, that some of the drivers of volatility here is because the capital associated with intermediating and financing of U.S. treasuries is oversized, right? And therefore, it's capital and liquidity. There are different things. What we're talking about here is not a liquidity issue. We're talking about a financing issue, moving funding from one place to the other. There's not an inadequate stock of liquidity. There's not an inadequate stock of cash. So you come back to, and this is Sean's point, and I agree with him completely. If the volatility is driven by the fact that banks won't intermediate because we've gotten the cost of capital for low-risk activity wrong, we should contemplate trying to get it right and try to rebalance it so that we can have institutions engaging in that marketplace to support the financial plumbing. And by the way, it doesn't just matter for the financing and repo markets. HQLA and treasuries are critical to every aspect of our operating economy. There is no intraday unsecured overdraft anywhere anymore. Everything must be collateralized. For centralized clearing to work, it's all supported by collateral. So if our collateral markets don't function adequately and we don't get the velocity of collateral right because we don't have proper capital tied to treasuries, not anything else we're talking about here, well, then we're going to have a fundamental issue.
So I do want to add just quickly, I really need to. We have discussed that issue, I agree. I don't think we've agreed or proven, actually, the relationship between the capital and the assets. So I just want to be clear.
Yeah, and I just want to make one comment about volatility, and that is I really am in the camp it's a good thing. And the reason why it is a good thing is because it's going to bring new entrants into this market. Volatility means the opportunity to make money, very simply.
I think we.
But durability will
two
matter.
different
Durability will matter.
references to volatility today, just to be clear. I think there's a little bit of confusion. I would just clarify. So there's volatility in short-term money markets, where ample reserves and the huge excess reserves may have stamped out for a while, and so you're not seeing any fluctuations there or any like measurement of credit risk even in the short-term markets, because it's all. And then there's volatility from spikes at quarter end and year end and lead ups to reporting dates. So I think we're talking about two different things, and I just want to be clear. So I am really taking a couple questions from the floor. Okay. And then Bill Nelson, and then one more, and that's it. And then we'll take all three, and then we can.
So,
Thank you.
I think since
Please
most of
say
the
your
top,
name and where you're from, please.
I'm from the IMF. My
Yes.
name's Manmohan Singh. Although the topic is repo, the cash to collateral exchange happens in many markets: sec lending, prime brokerage, OTC derivatives. We understand the importance of repo market, especially the U.S. Treasury market. Now, if the U.S. Treasury market cannot find room in balance sheet space. When I mean balance sheet, I also mean off balance sheet, because when you read the 10Ks, a lot of this flows off balance sheet.
Yeah.
There has to be a way to either make reserves and treasury equal, either find balance sheet space for treasuries or make the reserves unattractive. Has the thought of lowering IOER so that there is more of an equilibrium between U.S. Treasury choice and reserve choice, assuming we can't find the balance sheet space?
Yep. Thank you. Bill. Bill Nelson.
Hi, thank you. Bill Nelson from the Bank Policy Institute. So I'll just note that I think the only two things that I've heard the bank representatives suggest is encouraging supervisors and banks to not have an unwarranted bias towards reserves and to calculate the GSIB surcharge on an average basis rather than on a year-end basis.
Or Pete.
That doesn't sound like a big ask, or in fact an easing. But in any case, let me then raise a couple issues. So,
Is there a question at the end of
There's
it?
two questions.
Okay.
So, when you go back to watch the video in which the board adopted the ESLR and the SLR, every board member around the table said, we're doing so because it is our expectation that as the GSIB surcharge rolled in. But anyway, it's our expectation that this will not be the binding constraint. Now, my colleague Francisco Covas at BPI has done some great work calculating what's the binding constraint for everyone. And what he's concluded is that for half the banks, the binding constraint is actually the SLR requirement in the stress tests. So my question is that an intended outcome, and is it a desirable outcome? The other question is, with respect to thinking about what an institution should do that's under stress, that has a big pile of treasuries, isn't that exactly what the discount window is for? Yeah. And that doesn't have a market impact. In fact, it isn't even visible. And so if the answer is yes, then, well, shouldn't that be the plan? And why not collateralized by treasuries, envision them using the discount window?
Okay. Thank you.
Short answers.
Questions?
No, I don't think we really have to stop. So I
Okay.
think we should answer
This
these.
is like, if anyone wants to respond, please, but short. Thank you.
Should the post-stress leverage ratio be a binding constraint? Is that what your question was? So I think leverage ratio in stress is actually a pretty good measure, personally. I think that it does a few things. It's nice and simple, as leverage ratios are designed to be, but it actually has the benefit of being risk sensitive as well. So you have an ending number post the stress that's actually very easy to understand. This is my capital. These are my assets. Right? If you remember back to the crisis, 2008, there were analysts all over the place doing these post-stress tangible common equity analyses that were freaking out the market. And that's, in a sense, this is a nice, consistent way to get the information out to the public that actually something approaching a post-stress tangible common equity ratio, here it is. That's the post-stress leverage ratio. Is it a good constraint? Well, I'm not sure. Constraint of what?
Yeah, so we could pick up on that just a little bit, yeah. And
I would
do
just
you
quickly
wanna-
address Bill's point about the discount window, which I basically agree with completely. But I think ultimately, there's sort of a, there's a human behavior sort of stigma issue associated with that, which would make it really hard to even under the best of circumstances, if the Fed would roll into every large bank and say, look, really we mean it. Really we mean it. There'll be no consequences, so on and so forth. It could be very, very, very hard for banks to internalize that and ultimately to use it. I think that getting rid of that stigma problem, at least if I understood your question correctly, could be very, very difficult.
And to wrap up that last piece too, is when it doesn't matter if people like or dislike the supplementary leverage ratio, it is embedded in banks' models, period, full stop, whether it's binding or not binding. And I think it's very important to note that the market is functioning very well in that construct because despite the fact that it's not a good risk reward on capital, it is part of the business model and the offering that needs to be provided in the services to underlying clients. The piece I think we need to focus on is that incremental support in intermediating, not business as usual. Why are financial institutions not leaning in? Why are they not showing up? And in that construct, maybe there's opportunity there to think about if you're fully in excess, if you are compliant with every rule out there, is there ability to deploy then these excesses into the market without drawing yet more incremental capital? That may also be a way to facilitate that incremental piece of intermediation.
So I know this could go on for another 6 hours, but I don't intend to spend 6 more hours on the repo market. But I do want to thank all the panelists. I thought this was a really good discussion of an important issue. One of our goals was to kind of try and get people together to talk about something for which there have been a lot of headlines, but I don't think there's been much understanding, and I hope we've at least advanced that a small way. So I want to particularly thank Nellie for helping me organize this and all the people who came to speak.
Thanks for watching. Be sure to like and subscribe for more videos from Brookings.